Hey everybody, Derrick Goldsmith here, senior trader over T3 Trading Group. Today, I just want to talk a little bit about trading around the holiday season. So we're approaching the end of the year. This is the Monday of Thanksgiving week that I'm recording this, and markets are closed on Thursday. I hope everyone really enjoys their Thanksgiving. Then Friday, the market has one of these rare half days. The market is always a half day on the day after Thanksgiving, so the US equity market closes at 1 o'clock Eastern. There's actually a really old rule that says that the stock market can't be closed for more than 2 days at a time. So we're closed on Saturday and Sunday. That's why the market has to be open at least for a half day on Friday. That Friday after Thanksgiving, and really any other holiday trading session, is typically really boring, except for once in a while when it's not. Why is it typically really boring? Because not many people are gonna be trading on Friday. Like a lot of other people, I'm basically giving myself the day off on Friday. The market doesn't have a lot of participants. It tends to not move as much. Also, there's a lot less liquidity because everyone's on vacation. And when there's a lot less liquidity, if an event does occur, you can actually get really crazy moves because there's not a lot of liquidity. You got the backup crew running the major institutional trading floors. And if an event comes, people are trying to move markets, there's no liquidity, you can get really big swings. I think in particular, 2008 during the financial crisis, that Friday after Thanksgiving was particularly insane. So that's what we can expect on these holiday type trading sessions. And basically what it means to you is if there's no real price action, well, don't do too much, don't churn your account. But if something does happen, be ready because it can create a lot of opportunity. After Thanksgiving, we approach the end of the year. So everyone knows about the Santa Claus rally. Historically, December is a pretty good month for the market. Based on history, it's the third best month of the year on average. Obviously, anything can happen, and just because something has happened in the past doesn't necessarily mean that it's going to happen in the future. But typically December is a strong month, particularly the second half of the month, and it's actually usually led by the IWM, by the Russell 2000, and usually by value type names. That last week of December into the first 2 days of January is what we call the Santa Claus rally. So it's usually a pretty strong week. And why the Santa Claus rally exists? Well, there's a lot of theories about it. And again, this is not a 100% type of thing. But what people say it is that they're front running what's called the January effect. So what is the January effect? The January effect on the market is that January tends to be a strong month. And the reason for that is in December, a lot of tax loss harvesting takes place, and then people put that money back into the market in January. Also, a lot of people will have their holiday bonuses that they're ready to put into the market. So it usually leads to a strong month. But when everyone knows that January tends to be a strong month, what are they gonna do? They start to jump ahead of it. So the Santa Claus rally in the market is a lot of times attributed to basically being front running of the January effect. The market anticipates that money flows are gonna come into the market in January, so they start buying the market up in December after they've already done whatever tax loss harvesting occurs. One of the other things that's sometimes interesting about December is that the leaders from the year a lot of times get an extra big move into the end of the year, and the laggards a lot of times sell off even further. Why does this happen? Well, it happens because of a combination of tax loss harvesting on the weak names and also performance chasing on the strong names. If you're holding a real dog and you want to get the tax benefits of liquidating that loss, you're probably going to be doing it in December. Whereas if you're a hedge fund manager, you might engage in window dressing into the end of the year. Or basically, if you weren't long like one of the best performers of the year, you might be buying it in December to really show that you had it on your books and be doing some performance chasing into the end of the year for your investors' numbers. So that's just some stuff to think about and possibly expect based on history for the next month and a half or so as we approach the end of the year. And I'm wishing everybody who's been following along with the new Derrick the Trader YouTube the best holiday season. Enjoy your Thanksgiving, enjoy all of your holiday season, and I'll see everybody out there.